Excellent. Well, I'll say good afternoon to everyone and thank you for joining us for the 2023 VCIM Investment Management Private Client Webinar. My name is Jordan Hopper and I'm an investment counselor with VCIM Investment Management. I'll be your host and moderator for today's event. I'd like to first acknowledge that we're gathering today on the lands of the Musqueam, Squamish, and Tsleil-Waututh First Nations. They have been custodians of this land for thousands of years, and I'd like to pay my respect to the elders both past and present. Today, I'm joined on our call by Mark Sheard, VCIM's Head of Equities, Jeffrey Liu, one of our fixed income portfolio managers, and Kelly Hirsch, our Head of Environmental, Social, and Governance Investing. Mark and his team are responsible for the stock selection decisions at VCIM, while Jeff and his team manage the bond selection decisions. Kelly and her team work with both the stock and the bond teams to ensure that all the securities that we invest in meet our socially responsible investment standards. Mark, Jeff, and Kelly head up VCIM's investment management team that is now nearly 20 individuals strong, all focusing on the security selection within VCIM client portfolios. 2022 was a challenging year for both stock and bond markets, and as such, we at VCIM felt it was important to provide an opportunity to hear directly from the key people on our investment management team. Our presenters will start with a detailed review of the past year, followed by a fireside chat component focusing more on our expectations for 2023 and the opportunities we're seeing. There will be a Q&A at the end, so please place your questions in the chat box within the meeting window. If your question goes unanswered, please forward it to your VCIM representative who will be happy to provide you an answer. If you have to leave the webinar prior to its conclusion, rest assured knowing that we'll be emailing out a recording after the full webinar. So without further ado, I'm pleased to introduce Jeffrey Liu, who will discuss the 2022 fixed income markets in review. Over to you, Jeff.
Great, thanks a lot, Jordan. So if we go to the first slide here, so overwhelmingly the markets in 2022 were driven by inflation. That was the key story of 2022. This chart here just shows the CPI, the inflation year over year for Canada and the US. So Canada is in red, US is in blue. The chart goes back to 1970, so you could see the prior spike in inflation when it got away. We actually started seeing a lot of inflation pressures building in 2021. We obviously saw the pandemic supply chain disruptions. Anybody who's ordered appliances or vehicles or that sort of thing have seen, the delays in that and prices kind of rising in that side of things. We also saw central bank policies remaining extremely easy for an extended period of time, and that caused inflation pressures to build as well. And then at the start of 2022, we saw the Russian invasion of Ukraine, which really pushed energy and food prices higher. So all those factors conspired to push inflation higher. So you could see that inflation actually touched 8 to 9% year over year in Canada and the US respectively in June 2022. On a year-over-year basis, we have seen that rate come down, but it remains stubbornly high. We are at just over 6%, kind of on a year-over-year basis. So that's definitely a concern for the central bankers. So as we go to the next slide here, the next slide shows the central banks and their response to this inflation. So this table here just shows the major central banks as well as where they ended 2021 off, as well as where their current policy rates are. So you can see here that Canada and the US have been very aggressive in their rate hikes. Both central banks were actually pretty slow to react to the inflation pressures. Both central banks hiked for the first time this cycle in March, and that was actually when inflation was already at 6 to 7%. So that's already, their targets are in that 2% range for inflation. So they were actually quite late in responding to this inflationary pressures. So as a result, they have had to hike quite aggressively. The positive sign is that these rate hikes have been slowing down the pace. In fact, Bank of Canada said in their most recent decision earlier this year that they would actually be on pause and would kind of assess the impact of these current rate hikes. US is not quite there yet, so we do see kind of some small adjustment, 25 basis point hikes along the way from the Fed still, but BOC, Bank of Canada, is kind of on pause pending inflation data coming down. As we go to the next slide here, This slide shows the impact on the bond market. So with central banks raising rates dramatically, you can see the impact on the yield curve. So these charts here, this chart here just shows the yield curve at the start of the year, which is the blue line, and the yield curve at the end of the year, the red line. You could see the dramatic shift up. Yields were higher by 160 to 400 basis points across the curve. A lot of that impact was felt in the very short-term maturities, as this is mostly driven by central bank overnight policy rates. So this kind of sets a tone for what we saw in bond markets. So if we go to the next slide here, this also explains what happened in bond markets. So credit spreads widened sharply. So credit spreads, essentially, when you buy a corporate bond, you're taking on more risk than buying a government of Canada bond, which is generally seen as risk-free. This compensation is called the credit spread, and in periods where risks are rising, the credit spread you get should be increasing. So what happened there was we did see credit spreads widen significantly in 2022, and at the end of the year, we're actually near their 2-year highs, just slightly below the pandemic start 2020 spreads. But as you could see there, going back to the 2018, 2019 cycle, we were actually above those highs in terms of credit spreads. So, and I'm going to talk about that and how that translates into the opportunity going forward in a couple slides. So the next slide here just shows the bond market returns. So combining rising underlying government Canada yields combined with widening credit spreads, that made for a very tough market return in the bond markets. So the FTSE Universe Index goes back to 1979, so 43 years of annual return history. And this 2022 was actually the worst year on record. As you could see there, we did decline 11.7%. The good news is, though, which you'll see on the next slide, is that these negative returns are setting the path for positive returns going forward, because as you could see in this chart here, this shows the various yields on a number of fixed income instruments. So your return component when you own a bond, one of the components of return is yield. It is a major component. And as you could see right here, the Government of Canada yield, 2-year yield, for instance, is over 4.2%. Just at the start of 2021, for example, that yield was 0.15%. So it just tells you how much extra yield you are getting now, and that's much more valuable when thinking of forward returns. Corporate yield, 5-year BBB is over 5%. Started 2021, that was under 2%. So that gives you a sense of return potential going forward. If we just go to the next slide here. So that kind of is a quick, in the nutshell, what happened in the bond market. So I'm just going to talk about how we integrate socially responsible investing on the fixed income side. So we have 3 components here. So we do have a in-house ESG team. So we will hear from Kelly later on. So our responsible investing process is fully integrated into the bond side as well as equity side. We are fossil fuel free since inception. So that means there's no companies who derive primary business from the fossil fuel industry, or so that could be oil and gas, pipelines, or coal-fired power generation, that sort of thing. And the last component that I'll talk about is buying positive impact bonds. So when a company issues a debt instrument, typically they have to outline what they're going to use the proceeds for. Typically, it's just general corporate purposes. With green and sustainable bonds, they actually spell out what they're going to be using the bonds for, and they actually have to be positive environmental or social impact projects. And so for us, we view those as being a good way to add positive impact to our fund. And in fact, as of the end of January, our fund had 23.8% of the fund was invested in these positive impact bonds. And I think that so almost a quarter of the fund was invested in there. This slide just outlines a handful of the positive impact bonds we hold in the funds. Now that concludes my portion. I'm going to pass it over to Kelly Hirsch, who is our head of ESG, and she's going to talk about some of our ESG engagement and other ESG initiatives.
Great. Thanks, Jeff. So to get started today, what I'm planning on covering, I want to go over some of the engagement work we've done. Particular, I mean, there's a wide breadth of this that you see, sort of year over year that you would have seen often in our shareholder engagement report. But today I really want to focus on a few topical areas and sort of work that we've done in 2022. And a lot of this work is really forward-looking too. It's work that we expect to continue on into 2023. So the three areas I'm really looking at today: human capital management and inequality, climate change, as well as biodiversity. So to start on the human capital management and inequality, on the next slide, so this is something Jeff touched on this. We've seen inflation at sort of record highs, sort of we're looking back over the past few decades. And this has really been reflected, a cost of living crisis for a lot of people. I think I know I'm feeling it. I'm sure you're feeling it too. Every time you go into the grocery store, it seems that things are more and more expensive. And when we look at the impact on people, the greatest impact is really on low-income households, particularly because a lot of the costs that we've been seeing increase are basic necessities such as food, energy, and housing. So on the next slide, these are a couple. I'm just going to go over a few areas that we've been engaging on in the past year and look forward to in the future. So paid sick leave is an area that we think can actually really help lower income households, and it's particularly topical for them. If you look at this chart here, we generally, if you're looking at the top income sort of individuals, they generally have paid sick leave. We're looking at 94%, 95%. But when we look lower down on the income spectrum, the bottom 25% of workers, only half of them actually have access to paid sick leave. And then if you're looking at the bottom 10%, only about a third do. And so that can put individuals in the horrible position, right, of trying, deciding, okay, do I go into work sick and potentially impact my coworkers, or do I put food on the table? And so that's something that we think is a key area to be, and we'll continue our engagements with companies to help address some of, the inflation and cost of living crisis. On the next slide, another area would be living wage engagements. So VCIM is a living wage employer, and we think it's a really important step for companies to take. And a living wage is really it's ensuring that an individual is earning enough to meet their basic needs, working a full-time job. So, to cover shelter costs, food costs, etc. There's no vacations to Hawaii on a wage like this, but it means that you're not struggling month to month to pay your bills. And why this is important is the minimum wage is actually, there's a few examples here on the screen, but the minimum wage generally in Vancouver, for instance, is about $5 lower than what an individual, needs to earn. And so this is something where we think it's really important for companies to be evaluating their wages in respect to this. And then one last engagement on the human capital management inequality theme on the next slide is looking at kind of broader, it's important to look at the protections for, lower income households and workers, but it's also looking at the systemic gaps that we've had, in inequality that we've really seen grow over the past few decades. For instance, this chart here outlines that since 1978, we've seen CEO pay, and I would argue generally executives as well, sort of overall at that level, we've seen their pay in real dollars go up 1,460% versus workers in real, the average worker would be 18%. So these are huge gaps, and it's something that I think there hasn't been enough attention on. We're seeing a bit more focus on it. The US now requires this disclosure, but a big part of actually our engagement work is with Canadian companies, because that is a big gap right now in the Canadian market, where Canadian companies don't have to disclose this information. And we think this is an important metric for companies to look at to ensure that we don't see these trends continue. And if anything, we see these trends actually, we want to see these numbers. CEOs and workers' pay should be rising in tandem. Next slide, please. Climate change, with everything going on, between like the war in Ukraine and the cost of living crisis, and it feels like, there's a lot of things going on. Climate change is still a huge focus. I think this chart's important to look at to see really the trends that, sometimes I think we can look at, one winter, one summer, get very focused on the short term, but it's really about looking back. Like this chart doesn't quite almost 150 years, but you can really see that warming trend that we've seen over the past years and why it's so important right now to keep, in the midst of all these, sort of different issues we need to address. Climate change is a very important one that we continue to focus on. On the next slide, we have, so we've actually seen some really good in 2022, really exciting developments on the regulatory side, so there's the Inflation Reduction Act passed in the US, which actually is it is the most ambitious climate legislation that we've seen. And in many ways, we're going to be feeling the effects of it in the years to come, because kind of when it's announced, everything isn't finalized yet. We're really starting to finalize, see where these credits are, see where the opportunities are. And I think that's the important piece to focus on here, that it really is, there's a lot of opportunity for, companies that are taking, that are invested in these sectors, companies that are taking, really focused on this area. This legislation is really, sort of as the slide here says, it's really carrots over sticks. It's about incentives. It's about, there's an opportunity here. On the next slide. So I just want to touch quickly on some areas. We've done a lot of engagement work on climate for many years, but these are some exciting ones that sort of in the past year we've been working on, and we expect to see a lot more work in the year, sort of in the upcoming year. So climate, to start with, Climate Action 100 Plus is a group that we're a part of. It's a global group of investors who are focused on coordinated engagement with the highest emitter, companies with the highest emissions. A lot of this can be oil and gas companies, but also sort of some companies that obviously, which we don't invest in, but companies such as, for instance, a company we hold, Train Technologies, which is a leader in this, but they have its HVAC systems, so heating and cooling, which can be very carbon intensive. So that's something where, we work with them to see them really help drive change and lower carbon emissions here. The next one, Climate Engagement Canada, Vancity, we are a founding member of this organization, and it's really trying to build on the great work that Climate Action 100 Plus has done, but with focusing on Canadian companies. And as well, I do like to highlight, it's something where we are, specific to the Canadian context, we are engaging with the Canadian financial institutions on their fossil fuel financing to ensure that they're implementing, the proper transition plans and working with their clients to ensure that they're not funding, expansion of fossil fuels. On the next slide. And so the last topic I wanted to cover briefly would be biodiversity. This is an area, I think actually 2023 is sort of really the year, I think there's going to be a mainstreaming in a sense of biodiversity, where I think there's been a lot of talk about it. And we really saw some exciting developments back in December, which you may have seen in the news, the COP15 2022 UN Biodiversity Conference, where we had, sort of where we had governments all come together and really form the basis, much like the Paris Accord was formed for climate. We saw them form the basis of a framework for biodiversity going forward, to really look at these. One of the key things, a notable piece of this that we didn't see as much in the news, is actually countries have committed to requiring multinational companies to start evaluating their, evaluating their impacts on biodiversity through a financial lens. On the next slide, wanted to highlight, so this is actually an area where VCIM, we've already been focused on. Because when we're looking, we think this is a key piece. There's so many financial, our financial system is really dependent on, well-functioning ecosystems. So Costco, as a company we really like, they have great human capital management practices going back, kind of to the beginning of my presentation, with good worker wages, benefits, working conditions. But an area where we looked, not that they're a laggard, but that they, could really improve and could actually have a leadership role, would be looking at the biodiversity impacts of their supply chains. And so that's been really exciting. So we've actually, we filed the proposal and we were able to come to an agreement with the company, and we've withdrawn that. And we're actually going to see them doing work looking at quantifying the impacts that their supply chains have on biodiversity. So with that, I hope that was informative about some of the work we have been doing and like upcoming work that's going on with the ESG team and shareholder engagement. And with that, I will pass it over to Mark Shearer to talk more about our equity strategy and looking forward there.
Thanks, Kelly, and hello to everyone on the call. And thanks for joining us today. So I'm going to start with equity market returns in 2022, and then just talk a bit more about why we're optimistic, moving forward. So needless to say, last year it was a difficult year. The S&P 500 and MSCI World Index were both down by just under 20%, and the TSX just under 9%, as you can see in the left-hand side of this slide. And there really are several things you can point to in terms of what drove these returns. But for the most part, and similar to what Jeff already said, it was some combination of rising inflation, central banks increasing interest rates in response, rising geopolitical risk, in particular the war in Ukraine, China's zero COVID policy, which altogether led to fears of an impending recession. Markets with exposure to energy, such as the TSX in Canada, fared better on a relative basis, but on average, markets were negative across the globe. Most major markets were down for the year by double digits, and even bonds, which are generally seen as a safe haven for investors during equity market downturns, had a rough year, as Jeff touched on. So there have been very few places for investors to hide. The 60-40 portfolio, which is a very common asset mix for investors, and it holds about 60% in equities and 40% in bonds, was at one point late in the year on pace for its worst year ever, which really just summarizes quite well everything you need to know about this past year. It wasn't until the fourth quarter, when the pace of central bank tightening slowed and inflation started to trend downward, that we saw some positive performance as investor optimism returned, and this is carried into January of this year. Moving on to the next slide, which digs into the annual returns just a bit more, and it breaks it down by sector. As you can see in these two charts, which shows the World Index on the left and the TSX on the right, there's a major divergence between sector returns last year, and it's unlike anything that I personally can remember. Energy was up by about 41%, driven by mounting supply issues and the war in Ukraine, and was the only sector in positive territory when looking at the World Index. So last year, energy outperformed the worst performing sector, communication services, by more than 78 percentage points. I mean, there's nobody out there that would have predicted this at the beginning of the year. And historically, during periods of market stress, investors tend to rotate into high quality stocks for safety, which means sectors such as energy tend to fare quite poorly, and sectors such as information technology tend to outperform. But during last year's market pullback, it's been the exact opposite. But I should note that underneath these results, there's also a divergence in terms of the returns between specific companies. As speculative growth, unprofitable companies were amongst the biggest losers after having run up by significant amounts during the pandemic. And those companies tend to be more prevalent in higher growth sectors such as IT and communication services. But looking forward, we're starting to see some green shoots in the economy, which is a big part of the reason why market returns were strong at the end of last year and January of this year. As you can see on the next slide, CPI, which is of course a measure of inflation, it comes out monthly, and right now it's probably the most watched macro news release by equity and fixed income investors alike. It's starting to come down, as Jeff touched on, after peaking midway through last year. And this is quite positive for a number of reasons, including the basic fact that higher inflation has an impact on each of us on a day-to-day basis. But also, when you look back over time, equity markets have had very strong returns after peak inflation during periods of heightened inflation, which we deem to be times when it went above 5%. We looked at 6 month, 1 year, and even 5 year periods, and the returns were very strong across each period. And this is part of the reason why we're so optimistic. I mean, historically, markets have turned positive before the macro data has dramatically improved. As the market, it's anticipatory, and it will often turn positive prior to the data bouncing back. And it's because of this that right now the risk is to the upside in terms of market returns. And in the past, following periods of down markets, when the market does turn, it tends to be quite strong right out of the gate. Of course, it doesn't mean that we should all expect markets to now go straight up. You should never bet on where the market is going to move next. That's a fool's errand. But it does give us confidence as we move forward that the probabilities are on our side. Now, moving on to the next slide. As inflation has started to retreat, central banks have started to slow the pace of rate hikes somewhat, and this is true across most central banks globally, but rates are still rising overall, so it's obviously not a 180-degree change. But again, the equity market is forward-looking. You can time the exact date when the Bank of Canada keeps rates flat or when inflation hits 2% and still be unable to make any money in the equity markets. By that time, we'll probably already be in an upward market, and chances are that you missed some of the best days. But again, the slowing pace of rate hikes is just another positive data point for equities. And for us on the equity team, the current volatility and market drawdown are actually presenting us with a chance to dramatically improve the forward return of our funds. And the market has almost indiscriminately been selling companies for non-fundamental reasons. As an investor that is much smarter than myself once wrote, out of crisis comes opportunity. You make most of your money in a bear market. You just don't know it at the time. And this is somewhat evident on the next slide, which shows the price to earnings ratios of the world index, S&P 500 and TSX, all of which have seen it come down quite a bit over the last year. And this is probably the most common metric used to measure the valuation of a company or index, whereby lower is of course better as you're paying less for a dollar of earnings. And basically what this chart is saying is that the market is currently on sale, and we of course want to make sure that we don't miss it. So we've spent a lot of time on the equity team over the past several months kind of reviewing high quality companies for potential inclusion in our funds, as well as reassessing our current holdings and pushing the weight of companies that have been hit hard for non-fundamental reasons. And down markets are of course unnerving for investors. I understand that. I'm also an investor in the funds. Nobody likes to see the value of their portfolio fall, but as I said before, it's in times like this that you can make outsized returns going forward. Buffett always talked about how he would actually pay a certain amount of money to have the prices of his holdings cut in half, because he understood the long-term thesis and growth runway of each of his companies. And if he could lower his average cost, the returns would be enormous. And finally, this last slide, it touches on something I already talked about briefly, which is timing the market versus time in the market. And the table on this slide really drives this point home. Now, this table looks at price returns on the S&P 500 going back to 1928, so it excludes dividends. And what it's showing is that an investor that missed the best 10 days, which equates to only 0.03% of all days over this period, would see their annual return over the last 95 years fall by more than a percentage point, from about 5.9 to 4.7%. Missing the best 50 days, or just 0.14% of days, would see returns fall to only 1.7%, which is below the average level of inflation of around 2%. So no one can predict the future, right? But we know that the market goes up by more than 2/3 of the time on any 1 year period and more than 80% on 3-year periods. So the goal for most investors is to simply hold on long enough to benefit from these rebounds and to avoid trying to time the market. And with that, Jordan, I will pass it back to you.
Excellent. And thank you everyone for those insights, just a little bit about the environment that we encountered in 2022. I know, speaking for myself, I've had a few more gray hairs pop in over the last year or so, I'm sure that's similar across the board. Let's move forward and start discussing our expectations for 2023 and the opportunities that we're starting to see. Mark, I'm going to keep you in the hot seat here with some questions on the equity side first. And we recently released our 2023 Portfolio Manager Outlook at VCIM. In that outlook, we talk a lot about moving into a higher inflation, higher interest rate, and slower economic growth environment. So given this challenging environment, how do you look to position the equity funds to provide positive performance in this type of environment?
Yeah, thanks, Jordan. So as I said earlier, our focus right now is on turning over as many rocks as possible. Company valuations are very compelling, which means we have a long list of potential names on our to-do list. You know, one thing that I should note is in an inflationary environment, the best possible defense that a company can have is pricing power. They need to be able to pass on any cost increases to its customers while ensuring it doesn't affect how much they sell, of course. I mean, it's no good if you push prices 10% and volume falls 15%. And so the companies that we hold in our funds, on the most part, we're looking for high quality firms. They're the ones that have this pricing power without having it impact volumes. So, you know, we're always looking for companies that can hold in pretty much any economic situation. And right now it's when that really shows up. And on top of that too, if we're talking about higher interest rates, I mean, where do those have the most impact? It's on companies that hold a lot of debt. And one of our rules of thumb is to avoid companies with a lot of leverage at all costs. And holding a lot of debt, it might not be a problem during most parts of the economic cycle, but it's times like this when it really shows up, which is why we avoid it like the plague. You know, one other aspect of the current economy that we haven't touched on, although Kelly kind of touched on it briefly there, is the scarcity of labor. I mean, anyone who has tried to go out for dinner recently or go on vacation have noticed how short-staffed many companies are, especially in the service industry. And for us, having a focus on companies with strong ESG metrics is a huge benefit of these. These are the companies that tend to have strong employee relations, which translates into longer tenured staff and lower turnover. I mean, Costco is a perfect example. You know, like Kelly said, they pay wages well above peers and provide much better benefits than its counterparts. And right now, that's a massive advantage. I mean, they're one of the few retailers, especially in the discount retail industry, that aren't concerned about a lack of employees or having any difficulties hiring. Again, this is just, you know, another example of something that we focus on during any environment, but it really shows up in times of economic stress. And just one more thing too, we also feel very strongly that we're well positioned for when the market ultimately turns. I mean, last year was an outlier in terms of sector performance, with, you know, energy outperforming by a very wide margin. And I'd be very surprised if this continued into this year. You know, we feel pretty strongly that quality is going to come back into focus, and this is going to be proven out as earnings are announced and, you know, these companies continue to grow their market share and reinvest back into the business. I mean, although the market might not reward them in the short term, over the course of the cycle, we expect them to generate, you know, very attractive shareholder returns. I mean, our goal is, of course, to grow client capital over the next 3 to 5 years, you know, not the next week or quarter.
That's excellent. Thanks for that commentary on that, Mark. And you kind of touched on it a little bit more at a higher level, so maybe I can twist your arm a little bit. And you mentioned Costco. Are there some other favorite businesses, maybe 1 or 2 other favorite businesses at VCIM that we invest in? And maybe you can talk about what makes those businesses so durable when we have an environment like we're seeing right now, in addition maybe to the pricing power?
Sure. Yeah, so we've got lots of examples, to be honest. I'll try to pick one from our Canadian equity and one from global equity. So the first one I'll talk about, and it's from our Canadian equity fund, is called Jamieson Wellness. And it's a leading manufacturer of vitamins in Canada and internationally. In fact, many of you, including myself, would have Jamieson products in your household. And the advantage that Jamieson has is that consumers associate the Jamieson brand with quality. So when parents give vitamins to their children or elderly members of the family, they know Jamieson can be trusted. I mean, this level of trust and brand awareness by its customers is, you know, a critical reason why the company can sell its products at higher price points than generic brands. And on top of this, like the vitamin industry, it's very strong and durable. I mean, regardless of economic conditions, you know, the purchase of vitamins tends to be viewed as a household necessity, you know, and not something that is discretionary in nature and can be cut back on. When consumers are hit with higher prices, you know, they may move over to no-name, I don't know, paper towels, dish soap, or canned goods, but they don't tend to trade down in either over-the-counter medicines or vitamins, which has resulted in Jamieson providing kind of very consistent results through a number of economic downturns, and we don't expect that to really change anytime soon. You know, and within the global equity fund, again, we've got a lot of companies in that space that we see as kind of mission critical. They provide products or services that their customers can't do without. To be honest, Jordan, probably one of the best examples, I'll continue on with it, is Costco, because this is a very strong environment for a company like that. And it's a very unique business model. I think everybody on the call understands what Costco does and how good they are at it, but I don't think they fully understand why it is that they're able to be so successful. Because the low-cost business model that they employ, it's really not unique. I mean, discount stores have been around for decades, really since the opening of the first Walmart. But Costco's really taken it to another level. In our opinion, is so far in front of the competition that we struggle to see how it could be disrupted. And the first thing you have to kind of realize about this industry is that it's very difficult to differentiate yourself. I mean, each retailer, it's really selling basically the same products. And the founders of Costco realized this from day one. They understood that if you could keep the operating costs low, hence the warehouse look, buy in bulk, hence the 2-liter mustard bottles, and offer low prices, that they'll attract more and more shoppers. And other retailers such as Walmart, they've also realized this. Of course, it's not a profound insight, but Costco's taken it to another level, and it all starts with the fact that they refuse to take more than a 14% return on any product they sell, and there are no exceptions to this rule. And for context, I think it's about half the return that Walmart generates on average. So every product in a Costco store generates approximately the same return for them, no matter what. And if Costco happens to get a better deal on a specific product and pays, I don't know, half as much as they normally do, the entire savings is passed on to the customer. And other retailers are unable to match these margins. I mean, for most, it would actually result in bankruptcy. And by the way, a little interesting tidbit, this obsession with keeping prices low is also the reason why the cost of a hot dog and a drink at Costco hasn't budged from its initial price of $1.50, which it introduced in, I believe, 1985. So needless to say, we're pretty happy to have it as a core holding.
That's excellent. Excellent commentary. And I think everyone's happy to see the price of the hot dog there staying where it is. So that's always a plus. I appreciate the commentary on the individual companies. We're starting to hear a little bit more chatter now, Mark, about the R word, recession, potentially the next 6 to 18 months, where we'll actually see a real recession. And so the hope today is really to chat a little bit about, maybe if you could tell us, what does that mean for stock market returns? If we're about to enter a recession, why keep that market exposure? What type of performance can we expect maybe in the recession and then coming out of the recession?
Yeah, it's a good question, and a very common one too. It's not surprising. I'd say based strictly around the questions I've received over the past, I don't know, several months, the focus right now, pretty much everyone, including professional and retail investors alike, is the likelihood of a recession, under the belief that it'll lead to further market declines, of course. Like everyone else, of course, I don't have any ability to forecast the future, especially when it comes to macroeconomic events. But one thing that we do like to do, and I've already touched on this a little bit, but it's an important point, is to look back at past markets to help us understand, what may occur. History may not repeat, but it does rhyme. And if we're headed into a recession, or as many people feel, if we're already in one, based on past markets, we should actually see positive returns going forward. And so according to one recent third-party study, which looked at periods where the market experienced, it was both a bear market and a recession, which would fit with our current situation, as again, some people already feel we're in a recession. Forward annualized equity returns averaged around 47% and 20% on a 1-year and 3-year basis. And we found very similar data when looking back during periods where it's only a bear market or only a recession, as well as during times when inflation was above 5%, as I said earlier. Even going back to the 1970s, which everyone is referencing right now, when inflation hit more than 12%, the S&P returned, it was about 25% over the 6 months following peak inflation. So history is definitely on our side. And again, this comes back to what I was saying earlier. I mean, it's very difficult, if not impossible, to time changes in market trends. And historical data has shown that missing a positive turn in the market can negatively impact an investor's future returns. I mean, during the financial crisis in 2008, the stock market was nearly halved in value. And I mean, at that time, it was very difficult to kind of foresee a full recovery that would transform into an 11-year bull market. Again, this wasn't a smooth ride. It didn't go straight up. But if you didn't hold on, or you missed out on that, you missed one of the best decades that the market has ever seen. And for whatever reason, I don't understand why, but historically, the best return days, they tend to follow very closely behind the worst days. So you have to be ridiculously nimble and moving in and out of the market to avoid kind of those big down days, while still benefiting from the up days, which is, it's just not a reasonable strategy for anyone that wants to compound their returns at a good rate. As I've said to many of my own friends and family, I mean, the stock market, it's a wonderful compounding machine that we should all look to benefit from, but the cost of admission is volatility and occasional down markets.
Excellent, thank you. And I think reiterating that it's really the time in the market, not timing the market, that leads to successful outcomes for an investors. So I think that's really great commentary. The last one before I let you go, Mark, is just to talk maybe a little bit about some of the sell and the trim decisions that we made in 2022. So some of our clients may have noticed, throughout 2022, we did make quite a few sell decisions, and we also trimmed some existing names that we had held for quite some time in the portfolio. What type of factors go into that decision for yourself and the team when you're looking at maybe selling an equity fully or trimming the position?
Yeah, that's a fair question. One thing I want to say first off is that we're always assessing our portfolios and making sure that we're comfortable with the holdings. We try to start each day like we have a clean slate and look at our portfolios with an unbiased lens. And when we're assessing a new potential holding or looking at divesting an existing one, our ultimate goal is to high grade the portfolios. All we're trying to do is just constantly upgrade the quality of the portfolios and hence lower the risk. And so when it comes to deciding whether or not to sell a position, we use a very systematic process, which we categorize into 4 buckets. So first off, if fundamentals are deteriorating, and of course we'll want to take a very long, hard look at the situation. And often what happens is we were either wrong about our assessment of the industry's competitive dynamics, and perhaps there's a bit of a pricing war going on where the lowest wins, or the strength of the company's competitive advantage isn't exactly what we thought it was. And perhaps too, I should add into that, if management misallocates capital, possibly via an ill-suited acquisition or a lack of reinvestment into the business, that's another kind of warning sign for us. Secondly, opportunity cost, that's a big one. Basically, if there's a better opportunity, then we'll make a switch. Valuation is another consideration. We won't be looking to sell as soon as it hits a preordained price, but we want to take advantage of dislocations in the market. And this includes when participants get greedy and push valuations too far. And finally, if there's an ESG breakdown, we'll sell it immediately. And we did this a couple of times last year. And before I hand it back to you, Jordan, I should also point out that during times of heightened volatility, such as last year, we'll always be more active in terms of selling or trimming names and adding or increasing the weight of companies. As those are the markets that provide the most opportunity. On average, we expect to hold our companies for around 5 years. So you should expect turnover of about 20%. Going forward, we do expect it to be less than what you saw last year. Our goal is to compound our members' returns, and the best way to do that is to buy high quality companies and allow the power of compounding to kind of do its work.
Excellent. That's great color for everyone on the call, Mark. We really appreciate it. Thank you for that and taking the time. And there's an old saying that goes, as January goes, so goes the year. And it's been a great start to January. So we'll hope that holds true for us here in 2023. With that, Kelly, we're going to switch over to yourself. We'll chat a little bit more about our socially responsible investment process at Van City Investment Management. And of course, this is a core component of our investment philosophy at VCIM. And so I'm hoping we can start off the chat with, just yourself providing a high level overview of what our SRI process involves when we're, assessing a company for investment in our client portfolios.
Yeah, for sure. So really in tandem with Mark's team, so Mark's team is taking, as we've already discussed a lot on the fundamental side. My team at the same time, we're looking at sort of different ESG factors. I'd say to start, so there's the negative screening, where we're really looking to make sure that we're not investing in companies that have exposure, significant exposure to fossil fuels, tobacco, etc., some of the other negative sort of products and services, but also really to look at dig in a bit deeper, potentially on the controversy side, on sort of how they're operating, sort of are there significant sort of bad business practices that a company has, where they may not necessarily be excluded for their lines of business. But we also want to make sure, we're investing in companies that have, overall, good business practices. And then that sort of leads in, and it's done in parallel when we're looking through our positive screening tools, really looking at companies across 7 factors with a holistic approach, looking at how they treat their employees, how their diversity, inclusion, and equity practices, looking at their environmental performance, looking at community relations. How are they operating? Are they good, in a sense, good members of the community, giving good jobs, providing good jobs, being a good neighbor. Obviously this depends. Each sector can be, there's different weightings in different places for different things here. But also, looking at corporate governance is a really important piece too, to make sure they have, sort of that independent oversight of both things, both general oversight, but also looking at to make sure that the company, I think, as we've seen ESG risks, become more financially material, to make sure that they have, board oversight of those issues, as well looking at human rights and supply chain, and then as well sustainable products and services, to make sure that the company, sort of companies are not, there aren't sort of negative, so that we are, fully accounting for any, sort of potential negative externalities. So yeah, and then sort of looking, we use a variety of tools to do this. I mean, we're looking at we carbon footprint the portfolios to look at some of that potential climate risk there, and we also use tools through MSCI to look at impact revenues, and this would be on with revenues tied to achieving the UN SDGs, and different things. This can be from renewable power to providing, sanitation services and things like that. And so, yeah, we take a really in-depth look at how companies, holistically are managing these issues.
Awesome, thanks. And I think sometimes, Kelly, maybe we think of environmental and we forget about some of those social factors and the governance factors when we're, thinking about what makes a business socially responsible and when we're investing in it. So that's really nice commentary. I know, speaking for myself, speaking with clients at Vancity Investment Management about socially responsible investing, a lot of times we talk about it as also a risk mitigation tool. And you mentioned how environmental social governance factors, how those risks are having more of now a financial impact that we have to consider. And so can you give us maybe a name or two of a company that we've avoided or divested from in the past because of an environmental, social, or governance concern that we had with the business?
Yeah, definitely. There's kind of a couple. One, this goes back a little bit, but I think it's actually, in many ways, it's played, we've seen it played out, where we actually divest. I mean, before Facebook was Meta, we divested from Facebook actually many years ago, really from an ESG perspective. That was the driving force, where when we were looking at, not just, I know a lot of people, Cambridge Analytica and some of the kind of the big headlines. For us, we really started diving in, and we were looking at their business, their expansion strategy, where they were pushing into countries such as Myanmar, and that was at the time before the most recent military coup. They were really, their products were being used in really poor manners, and they weren't putting the right systems in place to really manage. We could see clearly that they weren't able to manage these risks, and that we would see, sort of financial downside from that. And I think that we've seen that play out in recent years. And I think another one, though, that a little more recent would be actually Chartwell Retirement Residences. So, and this is where you can actually see some of this tie of our shareholder engagement to our ESG process. So Chartwell Retirement Residences, they have long-term care homes, which obviously the pandemic really, sort of highlighted a lot of issues there. And so we, in this, used our, the power as shareholders to engage the company on, sort of their practices, particularly on employee relations. This ties back into some of the stuff I was talking about on our living wage engagements. Where we, for us, when we're looking at this, we think that, sort of employees should be making a living wage, and it became very clear that their employees weren't. So this was something we had a number of conversations with the company. We weren't able to come to an agreement. We brought, a shareholder proposals to a vote. Even there, a lot of human capital management proposals that have been brought forward received really strong support. We had follow-up conversations with the company, and honestly, we just weren't seeing them taking. They didn't understand, you could see that management didn't fully understand how important this was for their not just financial viability, but also, to be a good corporation, a good long-lasting sort of company. And so this was something where we actually did make the decision to divest from the company as a result of this engagement and the fact that we didn't think they were not managing a material risk to their business that really sat on the social, again, like on that the social side of things. Because I know often ESG, like you said, people tend to think of the E, but I really think a lot of the S and G risks are really important too.
Super, thank you so much. And speaking to that shareholder engagement piece, that's really another part of the process for us in the socially responsible investment philosophies, making sure that we're using our right as owners of the businesses to impact how management chooses to run that business. So I think you touched on that really nicely. And for the purpose of time, I think we're going to bring Jeff in just to get some fixed income questions as well before we switch to our client questions. So Jeff, when ready there. Obviously, you mentioned in your slide deck, worst year on record for bond performance in 2022. It wasn't an easy one. And now we've been having a lot of questions with investors about the higher term deposits that are now available in the marketplace. So maybe you can speak just a little bit about your expectations for forward bond returns compared to what term deposits are now offering.
Yeah, that's a really good question. So term deposits, you won't get that. The key advantage of term deposit is you're not getting that fluctuation in the principal like you would for a bond. So you would have benefited in an environment like 2022, but going forward, looking at kind of what we expect and even just where we expect central bank rates to go, we can see that the reversal of what happened in 2022 could happen going forward with the bonds. So basically, in a long way of saying that is, with a term deposit, you would be not having the fluctuation risk in your principal, but you would have a reinvestment risk. So after you buy the term deposit at the end of the term, you would be forced to reinvest at the rates currently prevailing at the market. So the problem is after seeing all these rate increases by the central banks, we are more likely to see a cut by these central banks, particularly if we go into a recession. So if we do see a rate cut by the central banks and bond yields fall, then your reinvestment at the time of maturity for this term deposit would be much lower. Instead, if you're investing in bonds right now, a longer term, you're locking in longer term rates, which, as I had shown in an earlier slide, the bond yields are at quite attractive levels, near 12, 13-year highs. So you're kind of locking that in and actually getting some upside if we do get those rate cuts. So if we do see recessionary risk, then you will get some capital appreciation on your bonds, and you're already getting pretty attractive coupons with those yields that I showed in that chart. Sorry, I can't hear you, Jordan.
Sorry, Jeff, I muted myself there. I was just mentioning, I guess the real message there is it's not just the yield that you pick up from a bond. There's also a capital gain component that you can receive if we see a lower interest rate in the future.
That's correct.
Excellent. So that's great to hear. And certainly with those term deposit rates being more competitive, we've been having those conversations, but I think we often forget to account for that capital gain pickup that's available when rates do come down in the future. Next question, Jeff, and this comes out of the PowerPoint deck that you presented at the beginning of our call. You noted that we invested at the firm, Advanced City Investment Management, in a positive impact bond issued by the City of Vancouver. Can you maybe talk a little bit about the bond issue itself and explain how the City of Vancouver has to use the money that they raised from that bond offering?
Yeah, absolutely. So City of Vancouver, they've actually been pretty early in on the game of issuing these impact bonds. So they actually issued a green bond in 2018, as well as a sustainable development bond in 2021. Proceeds have gone towards a wide array of projects. As I mentioned, these use of proceeds are going directly towards projects that enhance environmental sustainability. So in the case of City of Vancouver, a lot of them are, we have a nice local flavor, so we could actually see a lot of the spending happening here. So some of it is infrastructure, transportation infrastructure, or even just building upgrades. So they upgraded a fire hall, for instance, in terms of the energy efficiency of that fire hall, as well as wastewater management and collection, and all these sort of projects that have environmental benefits. That's what these bonds have gone towards. Some of it has gone towards work on the seawalls. So that's also in terms of climate adaptation and going forward, increasing accessibility for people as well, which has social benefits as well. So they do spend it on a number of things and projects that we see and feel in our everyday lives.
It's nice to hear some tangibles, especially being a North Vancouver resident myself. I know a lot of us on the call living in the city of Vancouver be able to hear the money's going to those types of usages, not only getting that financial return, but also having the positive impact and being able to enjoy it through upgraded seawall and stuff. That's great to hear. Last one for yourself, Jeff, and we'll just keep an eye on time here. But many of us on the team last week were at the CFA annual forecast dinner, whereby the former Bank of Canada and Bank of England Governor Mark Carney was the keynote speaker. And Mark's message really was that he expects no interest rate cuts in 2023 and probably maybe see some in 2024. So I know, some of the investors on the call might have mortgages. Some have lots of family and friends with mortgages. And we're just curious if you would agree with Mark Carney there on, interest rates are going to be staying where they are right now throughout the year, or if you think they could be cut sooner than 2024.
Yeah, so I would say I would agree with that. We're probably not going to see rate cuts just yet. What's different from previous cycles here is that inflation is remaining stubbornly high. So in prior cycles, if you look at how quickly the central banks have cut after their last hike, it's actually been under a year. So if you do think that the Bank of Canada is done with their hikes, then in theory you should be seeing cuts in not too distant future. We don't think that's necessarily the case because inflation remains high. If you look at the most recent inflation reports, are still kind of in that 6% range on a year-over-year basis. On a more monthly or 3-month annualized sort of pace, it's definitely coming down a little quicker, but there are certain components of that inflation which is remaining elevated, which is going to prevent them from cutting rates. Because recall they do have a 2% inflation target.
Excellent. Thank you for that background on interest rates. We'll wait until 2024 until we get a little bit of reprieve on that front. So with that, we're going to switch over now to questions that have come through throughout the presentation from VCIM clients and those attending the call. Jeff, the first one actually sticks with yourself, and it asks about the positive impact of investing in RioCan. I imagine this is one of the RioCan bonds that was showing on the screen there. So maybe you can just provide us a little bit more detail on the positive impact with RioCan, which really is a real estate investment trust.
That's correct. Yeah. So RioCan is a real estate investment trust. So they own a number of office or retail properties. The green aspect there with their green bonds, they have several green bonds outstanding, has to basically do with improving the energy efficiency of their properties. So they have a number of properties. It could be as simple as changing the type of light bulbs that they use so that they're using less electricity, or it could be in terms of managing the waste that those buildings produce, something along those lines. And so there is definite positive impact, environmental impact from spending on those projects.
Excellent, thank you. And Kelly, have we engaged with RioCan in the past as well as a company?
We have actually, yes. So because particularly the built environment, I think we sometimes forget what an impact the built environment actually has on climate change and carbon emissions. So it's something we have, we've engaged with we've had quite sort of regular meetings with them, actually encouraging them to adopt climate targets, that would see them, renovate buildings to make them more energy efficient. They have a really unique project actually in Toronto that's using like the lake water for like deep cool to help with like cooling and heating and temperature control. So it's actually something where it's where you can see the power of shareholder engagement really to impact these. I think real estate's something we tend not to say, oh, there's sort of rates over there, but they really have a big impact when we're looking at carbon emissions and impacts on the environment.
Awesome. Thank you for that commentary. Kelly, this probably aligns with your area. Mark, you might want to jump in at the end here if there's anything you want to add. But the question from the audience was, isn't the fact that the energy sector is up a bad sign for climate change?
It's a great question. I think energy is something where we've seen this over the years. It tends to go through spikes and drops. And this time we're not seeing companies, I think actually you're seeing oil and gas companies, they're not really reinvesting in like much expansion the way that they were, let's say in, before the last crash, where you had like Shell was going up into the Arctic to, explore for new energy stores. And if anything, I think right now, really with 2030 and some serious reductions we need to have, and that focus and a lot of government action that has happened since then. If anything, I think this is what's going to take the flip to get renewable and sort of the impetus for like the expansion of renewable energy that doesn't leave leave nations dependent on outside countries such as Russia or Saudi Arabia, that don't that don't share our values and that can wreak such havoc. I think if anything, this will this is the event that will actually. It's bad right now. I'm not going to say, that it's perfect, but I think in the long run, this is actually going to be one of those moments that we look as a really positive development for, sort of the expansion of renewable energy.
Excellent. That's great commentary. And just for the sake of time here, I think we'll probably look to conclude today's webinar. And so on behalf of all of us at Vancity Investment Management, thank you for those who attended. Again, if your question wasn't answered, please do pass it along to your VCIM representative and we will make sure to get an answer for you. And we do hope to send out a recording in a few days following the event if you would like to go back and listen to any of the specific pieces of the webinar. And so with that, thank you again and have a great afternoon.